Welcome back to Freedom Finance with Lanny, guys. Appreciate you guys for rocking with me. Today's video is really going to be centered around my 15 years of investing and really the 5 things that I would tell my younger self, aka the 5 things that I'm going to tell you on how to generate better returns, build better wealth, faster, earlier, so that you're stronger in your financial future, guys. Gonna make it quick, gonna hit it hard, gonna hit it heavy. So with that, grab your favorite beverage, your beer, your liquor, your wine, your espresso. Get that coffee rolling Sunday night, Sunday morning, Monday night. It doesn't matter. Freedom Finance is here, bringing it to you live, guys. So here are 5 things that I would tell my younger self regarding investing. Let's get it. So quick background, guys. I've been investing for 15 and a half years, and I've generated some great returns. Obviously, I'm trying to get to financial freedom earlier. Not quite there yet, but I am so close, guys. And especially if you guys have been following my journey, you've seen dividend income videos, you've seen dividend stock purchases, ETF stock purchases, dividend sells, dividend buys. You guys have seen it all. And, but let's get to a topical video. Let's get to 5 things that I would do differently, or 5 things I would tell myself during certain situations that would help my portfolio, that probably would have propelled me, and maybe even I would have been in financial freedom already had I followed these 5 things. Again, you'll see here it's about building wealth, building income, getting to financial freedom here. And I think if I would have done all 5 of these things, oh man, the mid-30s Lanny would have been very happy, guys. So let's start it right off the jump here. February of 2009 is when I started investing. You guys probably know the story, and if you don't, I was in the business tech lab at school, and instead of buying the Apple stock that I was so into at the time, February of 2009, instead I put money in on a T. Rowe Price Target Retirement Index Fund. And though the index fund, has performed just fine, Apple has performed so much better. So what I would tell myself, again, at the time I was in, barely over 20. I don't even think I was 21 yet. And, just by the S&P 500. Had I started in February of 2009, I think the S&P 500 was around 870. If you guys don't know, the S&P 500 is a little over 5,800 now. So that would have provided between 500 to 600% returns over that time frame. And, instead, I don't think I've performed quite as well from then to now with what I was investing into. But key point number 1 is, when in doubt, buy the index. Buy the entire S&P 500. So if you're 20, if you're 25, you're 30, 35, 40, 45, 50, and if you're just starting out investing, depending on your goals and horizons, but if you don't know what you want to do, but you want to put something to work, buy the index, buy Vanguard's VOO, all the other, ETFs out there. Just start and just do it, guys. And that's what I would have done earlier, what I would have told my younger self to do instead. Let's get into number 2, though. This is an investing / personal finance one. Number 2, again, I bought my house in the fall of 2011. Yes, been in my house now over 13 years. And, I did a 5% down, no PMI loan at the time. And, I remember my agent in 2011 was, you should definitely buy a bigger house. Buy a bigger house, buy more of a house than you think you need right now. And at the time, I was like, I'm frugal. I don't need much. I'm a minimalist kind of guy. Just give me a small house that has low maintenance, which is all fine and dandy, and it's great. And I've been in that same house that I bought 13 years ago. But I now know what she was referring to. She was looking at somebody who was, at the time, again, I was 22, 23 years old, buying a house, single guy. And she was probably thinking, you're probably going to have a family. You'll probably have kids. And if not, maybe a bigger house with more rooms is easier to sell. And if there's appreciation in the market, it's probably going to be worth even more than if you bought a smaller house. And I went with the smaller house, currently in that house, 3 bedrooms, 1,400 square feet. One of the bedrooms is an office upstairs. So right now we have 2 bedrooms. My toddler son is in one, and obviously my wife and I in the other. And we are now going to be a family of 4 guys. So, baby number 2 is coming on the way. Boom, mic drop comment. Let me know in the comments what you guys have done. And, congrats to all the other parents that have more than, again, all the families. And, those that have more, obviously, I know how much of a handful that probably has to be. So here we are, have another, we have a baby on the way, baby number 2. And we're in a 3-bedroom, 1,400 square foot house. We were already running out of room with the little guy. And I now see what my agent meant. Now we've been looking for a house for 3 years, and you guys already know what the real estate market looks like from rates and from pricing. But if we had maybe, even if we still had a 3-bedroom house, but maybe a couple extra rooms, maybe if it was 1,800 square feet, maybe 1,900 square feet, we probably would feel a lot better adding another one to the family. But things are a little tight in this house right now, and we're trying to figure out still, that new, baby room. More than likely that office is going to have to move to the scary basement. That's also small, but it's all good, guys. But telling my younger self, if you're first buying your house, and if you're in my type of situation, think about buying more of a house than you think you need. Because chances are you can't predict rates in the future, and more than likely real estate pricing will go up in the future. So you don't end up in a situation like this guy. Obviously it still has worked out, but now I understand what my agent meant. But let's get into number 3. Invest more. Keep that checking as low as possible. There are times when I was investing that I did push my checking account to the brink. In fact, there were times where, I think I had like less than $2, $3 in my checking account because of how I timed it all up and wanted to invest as much as possible. But looking back, I should have done that all the time, more often, putting every dollar to work, because money left in a checking account earning 0 should at least be moved into a savings. And if you fulfilled your emergency savings, then take that and move it into investing or to hit your other goals, whether that's traveling, buying another asset, maybe buying real estate, covering all your financial goals instead of just letting money sit there. Essentially allocate every dollar. So telling my younger self, telling you out there, invest more than you think you can. Really know how much you need in your checking account. And as long as you're covered on your emergency savings, invest everything, guys. And that's what I would have told my younger self, because that would have put me even further ahead than where I'm at today. 4. Tip number 4. Black swan events. Invest it all. What do I mean? Well, I was just starting to invest at the bottom of the financial crisis market. So I really wasn't investing as much. And really, I just started right during the time period. What was that next event? The COVID-19 pandemic. Obviously a terrible time period, probably one of the most traumatic events that our world has ever witnessed. But to take it back to the stock market terms, I should have invested it all. I should have invested everything that I had during that time period. Now, I was still investing, no doubt, but I was still kind of choosy, still was very, unsure of what was going to happen, if things were going to get worse before they got better. I was still investing, but I still had cash on the sidelines to invest during that, call it end of quarter 1, quarter 2 time period of 2020. And those were some of the best opportunities. Again, when others are scared and running out, run in and run all in. Definitely pounce on those opportunities when they are there if you can. So that's tip number 4. Go all in on black swan events. All right, this is tip number 5, guys. Number 5 that I would tell my younger self. Buy as much of those high quality stocks when you can versus buying a lot of stocks that are cheap. What do I mean by that? Well, if you're new here, a bunch of videos back, I probably showed my portfolio and talked about it. I had at one point to start the year, I think, between 70 to 72 different individual stock positions in my taxable stock account. How did that happen and how did I get there? Well, anytime a stock was undervalued, again, maybe it was because of trading fees or it was because of how much capital I had. But if a company was undervalued, I would, maybe put 300 in it, maybe 500, maybe 600, and then I would never add back to it. So then you end up with a lot of smaller positions. So that's one. Instead of like, let me look at stock A, maybe it's Aflac. Let me put more money while it's undervalued and put more money in and just keep investing in that high quality stock frequently, or in Johnson & Johnson, or in, insert stock that you believe to be high quality. Again, instead, I was just buying a lot of undervalued, possibly just cheap stocks just because they fit the metric. So that built up a lot of stock positions. And then the second thing happened where these stock positions also spun off entities. Think 3M with Solventum, think AT&T with Warner Brothers Discovery. Again, I can go down the laundry list of companies I've owned where they've had spin-offs. Pfizer with Viatris, MDU with, Knife River Corp. Again, there has to be 15 to 20 different spin-offs I've received in my time here investing. So all of a sudden, maybe I had 50 or 60 positions, and that pushed me over to 70 different positions. The one thing I learned is you probably should sell those spin-offs if you don't understand or you weren't buying that company to begin with. So that's like a little lesson that I've been now preaching going forward. But it would be to sum this one up, to invest more and more often into those, maybe it's 10, maybe it's 20, maybe it's 30 individual stock positions that are high quality versus spreading yourself so thin among 70 plus stocks, because 70 plus stocks takes so much time to monitor, so much time to keep up with, that it also detracts from the quality that you're providing to your own dividend stock portfolio, guys. So there we have it. Those are 5 things. 1, buy the S&P 500 younger, especially if you don't know what to invest in. 2, buy more of a house than you think you need if you're a first-time home buyer, or if you're in a position like me, again, single, possibly younger, buy more of a house than you think you need, because A, the house could sell more if it's a bigger house because most people are looking for a larger house, or B, your family grows and you do need more room and you're not forced to find another house in a higher priced market. 3, invest as much as you can. Keep that checking account as low as possible as long as your other safety nets and goals are being met. Invest the rest. 4, invest it all during black swan events such as the pandemic, such as the financial crisis downturn. Invest it all during those opportune time periods. And 5, invest and focus in on building high quality stocks versus buying as many stocks that are cheap. Again, your mind will thank you later and your portfolio will also thank you later. Guys, let me know what your favorite of the 5 tips to build your portfolio and wealth faster. Let me know what else you would throw in here, guys. Subscribe here, like the video, and I'll check you out on the next one.